Good morning, everybody. Guess we had a little technical hiccup. Let's talk about 1031 exchanges. We're going to talk about some weird things, taxes, math, a lot of legal stuff. You got to, don't lose focus, right? This is really all about money. This is an investor taking their investment property, picking it up, moving it somewhere else, continuing their investment, different kind of real estate, different location, all that kind of stuff, right? So I'm going to try and cover it, soup to nuts with you today, at least give you the basics, and then you'll be dangerous when we're done. Profitable sale of real estate. I think everybody knows it's the American way. You pay your taxes when you sell profitable real estate. Aunt Virginia wants a piece, Maryland, D.C., sometimes I use the term they're your partner in the transaction, whether you want them there or not. And so they want to cut. But they're willing to go with you on to the next deal. So if you pick this real estate up, roll it somewhere else, reinvest it someplace else, they'll stay with you. When you finally cash out, that's when you pay your taxes. So the idea behind exchange is you're continuing your investment. You're just moving it to a different location or different real estate. But you're still invested in real estate. That's the basic premise. Here's what we're going to cover today, a little bit about me and my company, Realty Exchange Corporation. What is an exchange? Where does it come from? What's the definition of like-kind? You'll hear that term, like-kind exchange. What does that mean? What is the timing and identification step? The government gives you a window of time to do this transaction, and so you got to follow those laws. How much do you have to reinvest to not pay taxes? We'll do the math. What is the role of qualified intermediary? I am a qualified intermediary. When you do one of these exchanges where there's a delay, where you sell and then you buy, you got to have a middleman, somebody like me, as part of the transaction. The process paperwork, and then we're going to talk about doing it backwards. The sequence for an exchange is sell and buy, but what happens if you want to buy something ahead of time? And then a little bit of endgame strategy, things I see clients doing with 1031 exchanges. What are their strategies? My dad started the company in 1990. So we're 32 years old, and this is all we do is 1031 exchanges. My dad wrote a book and put it up on Amazon. Dad's 91, and he rewrote the book, so there's a second version out there. And he published it himself and re-put it up on Amazon. There's a few typos in there, but God bless him, at 91 years old, he rewrote a tax book. Fascinating. He's a trooper. We're members of FEA, Federation of Exchange Accommodators. That is our national association of companies like ourselves. I'm a past president, sat on the board for many, many years, and I'm part of our lobbying team that goes on Capitol Hill and protects, tries to protect 1031 exchanges in the tax code. Most of our calls nowadays are Zoom calls with members. So I've been on calls with Tim Kaine and Senator Warner and Don Beyer, several other people on the Hill that are influential on taxes, right? I was part of a team that got law passed in Virginia. So Virginia has law on companies like ourselves. It's really about protecting the money. When you do an exchange, somebody sells something, money goes to an escrow account, and then we use that money to buy something else. The premise is the client, the exchanger, is not benefiting from the money in the middle of the transaction. So they don't get anything when they give up their property. So you got to use a middleman, somebody like us, and this is about protecting that cash, right? We use a system called Always Safes, which is how we do it, right? We've been at this very long time, and so we're very comfortable. What we do is protecting clients' cash. And then I carry a designation called CES. So we have an industry designation, some initials behind my name. I am not an attorney, not a CPA. I am a CES, right? So this is all we do. I do have a tax attorney that's part of our team, and I have plenty of resources. If I run into a question I don't have the answer to, I know who I can reach out to and try and get an answer. So we're pretty comfortable. This is what we do all day long, and we can help clients do 1031 exchanges. A little bit of a quick update. Maybe you've heard this, maybe not. There was a threat to 1031 exchanges. When we went through 2017, the tax reform, that was a big threat to 1031, even though it was a Republican-driven thing. Chairman Brady was after 1031 exchanges. His goal was to lower tax rates and take away all the goodies, right, the deductions and stuff. So he had 1031 on his hit list. We were able to save 1031 exchanges for real estate, but we lost 1031 exchanges for equipment, personal property, and business equipment. We were doing exchanges for those. When President Biden was running for president, as part of his proposals was to put a cap of $500,000 per taxpayer on an exchange. We knew this was coming, so we've been fighting this for a while. There is nothing in either the House or the Senate that is attacking 1031 exchanges. We're pretty successful, we think, of bottling that up. We have a lot of friends on both the D side and the R side of the aisle that understand 1031 exchanges. They've been at it a long time. We've been working this issue for many, many years, so we were able to protect that. In the president's most recent budget proposal, he's got the same $500,000 cap per taxpayer in there per year, but it's not going anywhere at this moment in time. As of today, I guess maybe you're seeing in the news like I am, there's a bill potentially that they're working on now, the Inflation Reduction Act. 1031 is not in that bill. So there's other tax raising provisions in there, but at this moment in time, that's not, 1031 is not on that hit list. So that's fresh as of this morning, right? But we're still working the issue, right? That's, you hear the term loophole. That's something that the government it's an easy word to use, right, without knowing the details. But we're constantly working this issue on Capitol Hill. Let's talk about what is an exchange, right, just in general. It allows a taxpayer to exchange an investment, rental, or business property and defer the tax payment on the capital gain. Normally there's a delay. Somebody sells, everything goes through a qualified intermediary, somebody like myself, and then they buy replacement property. That's what we normally see, right? A delay between closing of the old and buying the new. It could be 1 minute between the two, but there is a delay there, right? This is where it comes from. So this is part of the law. It's not a scheme, it's not a program, it's part of the tax code. No gain or loss shall be recognized on the exchange of real property. So with the 2017 tax reform, real is the word they added to the law. So that limits it to real property. Held for productive use in trade or business or investment if such real property is exchanged solely for more real property of like kind, which is also held for business investment, right? So that's a big mouthful there, but what that really means is a trade. That language means two people swapping deeds. That house on the left side there is a large residential property. The Hardys on the right side there is down in Franklin, Virginia. I don't know if you guys know where Franklin, Virginia is, west of Norfolk. These two guys find each other on Craigslist or whatever, and they like each other's property. They agree to trade deeds. That's an exchange. By definition, a straight swap between two parties is an exchange. You don't need a middleman if you're just trading deeds. We used to do exchanges on equipment, but those are gone now, okay? Then we had the Starker case. So he was in the timber business. You may have heard the term Starker exchange. He was a key guy in our business. So he was in the timber business, structured a couple of transactions where he gave up his ownership of his timber, and then the timber companies promised to replace his property. It was a couple of years later when they did replace his property. So he gave up his ownership, they promised to replace his real estate, and then later they gave him more forestry land. So there was this gap in time between ownership. He turned it into the government as an exchange, and they denied it. So wait a minute, that's not simultaneous. That's not a simultaneous swap of property. So he went to court, and he won. They challenged him a second time, he won the second time. So the key language is on there, if you can see where I highlighted, is the taxpayer's money still tied up in the same kind of property? And the answer is yes to that. Because he gave up property, but he didn't get anything, and then he still owns property when it's all said and done. So he's still tied up in the real estate, and he didn't benefit from giving up his real estate. So that's the key thing in the exchange. There can be a gap in time between giving up old and getting new. With the government, got a court case now, they got to deal with that delay, so they gave us a regulation, 1.1031K. So whenever you see a 1 dot in front of a law, that's the regulation. A deferred exchange, a delayed exchange, is defined as an exchange in which, pursuant to an agreement, When I set up an exchange for a client, I have an exchange agreement. So similar to the timber company, there was an exchange agreement, right? So you can almost think of me like the timber company. Taxpayer transfers property held for productive use in trade or business. Mr. Starker had held his forestry land. That's the relinquished, right? The one we're giving up. And then subsequently, later, receives property also to be held. He was still in the timber business. It's just a gap in time between the two. But the key is that's the sequence. You got to give up the old property and get the new by law, okay? And because that matches that tax court case. Most people need the money to get from A to B, right? But there's the sequence for an exchange. Who's the middleman? Well, this is all government stuff, so they made it up, right? So we are a fig Newton of the government's imagination. They gave us the definition. It's a person who's not the taxpayer or a disqualified person, meaning you can't do your own transaction. You can't play QI on your own. And a disqualified person means agency. If somebody's your agent, they can't play QI because they are you. They're the agent. Enters into a written agreement with the taxpayer, that's the exchange agreement, and as required by the exchange agreement, acquires the relinquished property from the taxpayer. Mechanically, when I sign up clients with my exchange agreement, they are giving me their property on paper for tax purposes. They no longer own it. Transfers the relinquished. I'm the one that sells the property, and that's why I get the money. But by definition, that's what's happening, okay? Acquires the replacement property. Client picks out what they want, and then I will buy it for them, and then I will transfer the replacement property to the taxpayer. So functionally, I step in as seller, take the money from the sale. Client picks out what they want. I'll use the money to buy their replacement property and make sure they're the owner. That matches up with the Starker case. He gave up his timberland and then later got replacement property, right? Here's a normal sequence. This is what we normally see. There's a contract to sell. That's your job as agents. Go help the client get a contract to sell. QI, somebody like myself, gets hired before closing, and then I'm assigned into the exchange agreement. I get assigned into the sale agreement. I'm stepping into their shoes to be the seller. That's how I get involved in the sale side. My exchange agreement, you know, basically I'm promising to buy what they tell me to buy in a certain time window that the government specified, right? QI closes and we deed directly from the client seller to the buyer. We don't need to go on deed. So it looks like a normal sale on the sale side with some stranger in the middle of the transaction. Client chooses and contracts for the replacement. So it's just like a normal purchase. Go get the deal, get it signed up, and then I get assigned in. It's a single piece of paper. I'm stepping into their shoes to be the buyer. I have the money. So I'm going to take the money and buy the replacement property, and then we deed directly to the client. So I don't go on deed in any situation. So the client gave up property. They get nothing but a promise from me, and then they pick out what they want. I buy the property for them and make sure they're the owner, just like the Starker case, right? So the government's just followed that court case. Let's do the math. So I told you we were going to do painful things, right? We got to do math. How much tax am I going to pay if I just sell? So here's my scenario. You know, I have a rental townhouse that's worth $500,000. I originally paid $150,000 for it. I've taken $45,000 of depreciation over time for wear and tear, and I owe $90,000. That's my debt. What I'm after is gain. What's the gain on this thing? I get a sale price at $500,000. I'm estimating $40,000 to get out. I use a rule of thumb of 8%, 6% commission, 2% for all the other stuff to pay for, you know, transfer taxes, pay the closing company, all that other stuff. Gets me down to what we call the adjusted selling price. I've adjusted for my selling costs. My original cost was $150,000. On this property, I didn't do any improvements. The big stuff, you know, new roof, you know, new wing, all that kind of stuff. I just did repairs to keep it running on a day-to-day basis. Less the depreciation I took. So, you know, as a rental property, you get to deduct your basis for wear and tear. So you get your annual depreciation deduction, right? It's a paper loss on your books, which adjusts your tax basis down, right? Because you're writing off your basis, basically. So I'm down to 105 as my tax basis, right? My adjusted tax basis. So my gain is the difference between the 460 and the 105. So I got $355,000 of gain on the sale of this rental townhouse. All right, what's the tax man want? The very first tax they pick up is the recapture of depreciation. So you're able to take that paper loss, right, every year, but if you cash out, you got to pay it back. It's at a max 25%. Some clients are in the 24% bracket. You never pay above your bracket, but the majority of people are going to be in that 25% range. That's 11,250. That's the one most people miss. They don't understand they got to pay that back, so that one comes as a surprise. The profit, the 310, the appreciation, right? That's your long-term capital gain number. That's at 15%. I'm showing 46.5 there. But I have a big paragraph there of caveats. We have a progressive tax system. The more you make, the more you pay. We're about to put 355 grand on somebody's tax return. They are rich for the year, whether they realize it or not. So the first tax that's going to kick in is that 3.8% net investment income tax. This is all net investment income coming onto their tax return. And if you cross over 200 for an individual, 250 married, which this will be, it's 355 going on a tax return, they're going to tack on an extra 3.8%. If they are making a lot of income, right, and their income goes above 459 for a single person, 517 married, the rate changes to 20%. The point of all this is that I'm showing 57,750 as a tax number. That's too low. Because we put this much money on somebody's tax return, it's going to ripple through that tax return. So there's going to be a much bigger number. I don't know if any of you have ever written a big check like that. I have. I call that your pain number, because you're in pain when you write that check. You got to remember, Virginia wants a piece of the action too, right? So Virginia's 5.75. So we're going to put 355 grand on your Virginia return. They want a piece too. So that's another 20 grand. So I'm showing 78 grand here. I'll bet by the time it ripples through the tax return, it's probably more like 90. So here we are selling this $500,000 townhouse, and we're going to have to fork over 90 grand, right? And you've been doing all the T's, right? Toilets, tenants, trash. I think we got termites, taxes. We got all kinds of T's. You have a choice. It's the American way. Pay your taxes, right? Bail out, be done with it. Or you can keep this money. Go buy some more real estate. This one's run its course. I want a different property. Let's go make money somewhere else. That's what exchanging is about, right? So you have a choice to make. It's a business decision. What can we trade into? So, here we are. We've done the math. We realize, oh, man, I don't want to give up that much money. I've been working really long time for that. That's my nest egg. I don't want to give it up. So what can I trade into? What's the criteria for an exchange? It's real property for real property. So I can go from any kind of real property to any other kind of real property anywhere in the U.S. as long as all the property is held for business investment. So I can go from dirt, farmers do exchanges all day long, into a rental beach house, into a hotel, warehouse, mix and match, all I want, anywhere in the country. So the definition of like kind is very, very broad as long as you're holding it on your books as business investment. That's the key. All right? And what that really means is no personal use, right? Because personal use is personal property. Or you're in the development business or the flipping business. That's held for resale. That's not held for investment. So it's got a different tax treatment, okay? This is also very broad in that it's all the bundle of rights. So I did a transaction not too long ago for a cell tower easement down in Richmond, about an acre underneath the tower and a little road that ran up to it, and for a conservation easement for timberland up in Maryland. I've done density rights, development rights. It's all part of the real estate. Oil and gas in Oklahoma and Texas, normal. It is a common transaction down there. So you got to broaden your horizons, broaden your thought process on what can be traded. I had a transaction here not too long ago for a lady that sold water rights on the north side of Denver. She had sold the land years ago, but she kept the water rights. And then somebody came in and buy the water rights from her, and then she bought a rental condo down in Fredericksburg. That was an exchange, right? Pretty straightforward. Because it's real estate. Since that's so broad, let's talk about the things that you can't exchange into, right? Primary residence. You don't trade primary residence. That's section 121 of the code, so that's a different section of tax code. Hopefully everybody knows the basics of that. If you're single, you can exclude $250. If you're married, file a joint return, $500,000 on the sale of your primary every 2 out of 5 years. So you could sell a home every 2 years and and keep $250,000 for single, $500,000 if you're married, okay? That's a standalone transaction. It has nothing to do with you buy something else or not. It's just a standalone transaction. The old rollover rules went away many, many years ago. That's long gone. When tax reform was working its way through Capitol Hill in 2017, there was a change to that, a bad change. It was in the House bill, and it passed, right? It was a change to extend that to 5 out of 8. And that would have been terrible for the home rules, right? Because if you had to live in your property 5 out of 8 years before you got your primary residence exclusion, that would have been brutal. The Senate bill came out, it was the same, 5 out of 8. That's bad, right? So when it went to conference, usually when both sides have a bill that's going through the conference, when they put them together, if they're both the same, they usually what comes out, but it didn't come out. Nobody changed it on the way out. So there is no change at the moment for the $250,000, $500,000, right? Second home vacation homes don't meet the exchange criteria because it's personal use. What tips over a property, right, to be personal use? If you're in the property using it more than 14 days per year, or 10% of the days rented, like you rent it 300 days, you could use it 30 and you're still fine. When that personal use tips over that, you've turned it into a second home, right? And what you don't count is maintenance days. So that's part of the process everybody goes through. They're personally using a property 14 days a year, but then they're down there doing maintenance on their investment property. And you don't count maintenance days. I had a friend of mine that had bought into a rental property in South Carolina. He wanted to do 6 months of maintenance on his investment property. I thought that was pushing the envelope a little hard. Dealer property, that's not exchangeable. What is a dealer? Builders, developers. They don't do exchanges. That's just their income. They just buy stuff, add value to it, and sell it. That's just income. So this is really where the flippers fit, right? They buy stuff, fix it, sell it. And God bless them, we need them. But that doesn't fit the 1031 exchange criteria, right? So this is typically the buy and hold space, which is what exchanging is all about. I've got clients that are in both businesses. They're in the rental business and they're in the flipping business. Our cheap advice to them is run 2 different businesses. I have an LLC that is my flipping business. That's just income to me. And then I have an LLC that's my buy and hold business. And don't taint the two. Don't put the two near each other. There's a court case sitting out there where a builder held raw land for 11 years, did an exchange on it, as I probably would have done. I've held the stuff for 11 years. That should be an exchangeable property. But for some reason it went to court and the judge got his books and it said work in progress on his books. Work in progress means inventory, no exchange. So he lost his exchange. So our cheap advice is if you're in both businesses, keep them away from each other, okay? Partnership interests are not exchangeable. What do I mean? Let me use an example. I decided to buy a beach house with my neighbor. The attorney told us to create an LLC. So down at the courthouse, the beach house is owned by an LLC, and I'm a member and he's a member. That's a partnership by definition, more than one. And so now it comes time to sell the property. The partnership, taxpayer all to itself, files a tax return and everything. It can do an exchange. But I hate my neighbor. I don't want to be with him on the next deal. But I don't own real estate. I own an interest in a company. That's not real estate. So what am I going to do? We go through processes which take a good bit of planning called drop and swap and swap and drop, or we're rejiggering the ownership before the sale. You got to do that well in advance. It's got to be planned out well in advance. Dropping out to tenants in common so that we get rid of the partnership, and down at the courthouse there's 2 of us, our names. Hold for a while, right, because now I have it on my books as a business investment property, my half, and then I sell my half and do an exchange on it. And I don't care what happens to him. I don't like him anymore. But I got to own real estate to do an exchange. We run into this all the time, right? All the time. And then property outside the U.S. is not like kind. You'd be surprised how many calls I get. Somebody's selling, they want to go to Costa Rica. Government doesn't let you not pay taxes and head out of the country. It doesn't work that way. Let's talk about timing for a minute here, right? The government gives you a window of time to do this. They don't let you just sell something and think about buying something else when you feel like it. You got to do it in 180 days. That's the window to do an exchange. And you got to identify in the first 45 days. That is the hard part of an exchange. No ifs, ands, or buts about it. You got to know where you're going in the first 45 days. You got to remember where the basic premise of this was in the past. These were trades, 2 people swapping deeds. Everybody knew what they wanted. So the basic premise of knowing where you wanted early is the genesis of this. So they didn't give you plenty of time to think about what you want to buy. You got to identify what it is in 45 days. When this legislation was going through Congress many, many years ago, Treasury had asked that you had to know where you wanted to go in the relinquished sale contract. So when you're selling, in that contract, you had to specify what you were going to go buy. Well, cooler heads prevailed, and at least we got 45 days, okay? What is an identification? What does that mean? So that's a piece of paper between the client and I'm the middleman. They're specifying to me which properties they want to buy. The government uses the word unambiguous. It's got to be clear what I want, what you want. You want a condo? I got to know the unit number. I got to be very clear which one. You can't just give me the address of the whole building and say I want one of the condos in the building. That's ambiguous. I think you're buying the whole building if you just give me the address. But I got to know the unit number, okay? There's 3 rules. One is called the 3 property rule, and that's the one most people use. They give me a list of 3 of any value. So I'm just looking for 3 addresses, right? Any value. The second rule is called the 200% rule, meaning if the list is 4 or more, the value of the list cannot exceed 2 times what was sold. So I use the example of a $500,000 sale. That means $1 million can be on my list if I choose to put 4 or more on the list. So if it's 3 or less, it doesn't matter the value. 4 or more, you got to worry about the value of the list. When would somebody use that? I see that when somebody's selling a large, maybe a commercial property, let's say it's a $2 million warehouse, and their plan is to buy several smaller dollar condos to replace that $2 million. They can give me a list of $4 million worth of smaller dollar condos, okay? The third rule is called the 95% rule, which we rarely see. It's sort of a catch-all. If the list is more than 3 and the value of the list exceeds 2 times what was sold, you got to buy 95% of the list. So I rarely see that. Functionally, you got to buy the whole list. I had a client sell a pretty large residential up here in Northern Virginia, and he bought 15 rentals from a little old lady's estate in Richmond. It was definitely more than 3, and all 15 together was definitely more than 2 times what he sold, but he bought them all. It's a package deal. So he used the 95% rule. The actual language of the law says you get 180 days or the due date of the tax return. So when we get into the later part of this year, you know, in December, somebody sells in December, the end of their exchange is actually April 15th, their due date of their tax return. If they need the full 180 days to close out their transaction, they file an extension, pushing out the due date to give them the full 180 days. But that's something we warn our clients about when we get to the end of the year, that the 180 days is shorter once we get towards the end of the year, right? Because it's the due date of the tax return, whatever comes first. I said the 45-day is the hard part of the exchange. There's no ifs, ands, or buts about it, especially in this market. Only those properties identified during the 45-day ID may be purchased as part of the exchange. You cannot change that list after the 45th day. The 45-day is also the moment to bail out of an exchange. So when we get, let me just paint the scenario. Somebody closes, clock starts, money's in escrow. I'm sitting here waiting for the client to tell me what to buy. If they do not identify at the 45th day, I don't know what to buy. I am stopping the exchange automatically, and I return their money on day 46. They didn't tell me, so we stop. So that's the first moment to bail out of an exchange. If they do give me the list, they've got a piece of paper they've given to me and they've signed it, they've committed me to use their money to only buy from that list, come hell or high water, all the way through 180 days. That's the hard part of an exchange. You got to lock into a list and commit to it, and I can't stop the exchange until all the way through 180 days. The way the law is written, the safe harbor, is you have the right to buy that property on that list, whether you want it or not, all the way through 180 days. So you can't call me on day 60 and say, hey, Bill, I'm leaving the country. I want to get my money out. I can't stop the exchange. We're locked in, okay? When, practical stuff, when you are in the middle of this market and you get outbid on those properties, right? You put 3 on your list and try and buy them, but you get outbid. When we took that to the government, their basic answer was, well, buy it from the new person. They don't care if it's a good deal or not. You put it on the list, so buy it. Money solves everything. So they don't have much sympathy for the market at this moment in time, right? What we typically see today is that clients are putting contracts on replacement properties ahead of time. This is not about contract dates, it's ownership dates. So when the client, what we typically see now, and the clients that are succeeding with their exchanges, when they get a contract to sell, it usually takes 30 or 45 days for the buyer to show up with the money. So in that window of time, they're putting contracts out to buy new property. And I realize that's cheap advice on my end and easy to say, but those are the clients that are succeeding. They're going to a seller and say, hey, please take my contract to buy as soon as I get my money from my sale. So immediately they close on the relinquished, they're already under contract to buy the new one, okay? So that's what we normally see nowadays. Can you get more time? Well, the very first extension was 9/11. We had Isabel, Florida's always having fires. Nowadays there's an automated process in place. When there's a disaster, FEMA steps in and presidentially declares the disaster, you get to add more time to both the 45 and the 180 days. Those are specific to counties. When the government steps in and declares a disaster, they publish on their website what counties are impacted, and if you're impacted in one of those counties, you get more time. Good example was Texas when they ran out of power. Was it last year or the year before? Texas got an extension, right? How much do you have to buy to not pay taxes? I'm going back to my scenario. $500,000 of my sale, basis, all that sort of stuff. This is a good slide. The idea behind an exchange is you're continuing your investment. It's the same investment, you're moving it somewhere else. That investment has a value. Here's my numbers. I got a contract price of $500,000. I got selling cost of 40. I'm down to that 460 number. To not pay tax, I got to go buy another 460 worth of real estate. Remember, it's the same investment. You're rolling it forward somewhere else. At closing, I pay off my mortgage, right? There's a hook in my property. I got to pay off my debts, and I'm left with 370 of cash. To not pay tax, I got to go buy again at 460 or more, and put all that money back in, that 370 of cash, so that I don't get anything out of the sale side. If I buy again at 460 and I put 370 down to buy that thing, where is the rest of the money coming from to buy this new 460 property? Most people go get another mortgage. Or you can put in cash of your own or some combination. But the basic premise, the thought process, is you're trading this 460 for more real estate of equal or more value and putting all the money back in so that you're not benefiting from anything. Right? That's the basic premise, right? We struggle with clients all the time on that issue because they think it's only the cash. Because you'll see on the internet in different places, you got to reinvest the proceeds. Well, they think the proceeds is just the cash portion after the debt's paid off. That's not accurate, right? The proceeds is what the buyer gave you. The buyer gave you $500,000. You got some cost to sell, so it's that 460 number. You just happen to owe money on the property. But the real number to buy, to replace, is the 460 number, and put all the cash back in. Let's talk about doing an exchange. You got to follow the safe harbor, right? The way the government told us to do it. There's some critical elements: intent, form and documentation, control the money by the QI, like-kind properties, and time limits. We talked about who is the QI, but what's a disqualified person? Disqualified means anybody who's got agency. So you guys are up there. You have agency with your clients. You can't play the role of qualified intermediary. Family, CPAs, they all have agency. What I bump into is the attorneys. So if the attorney is around here, title companies are typically representing the transaction. They don't necessarily represent the parties. So they could play QI if they wanted to. But if let's say it's an attorney and they did work for the client over the past 2 years, they created agency in the previous 2 years, then they're disqualified. So what a qualified intermediary means is that I'm not disqualified. So this is IRS logic. So you can have anybody be your qualified intermediary as long as it's not your agent. So if you want your neighbor Bob to play QI, God bless you, go ahead. Just better hope Bob knows what the heck he's doing. Let's talk about process a little bit, paperwork. This is a normal sales and settlement process, and I add a layer to it. So we start with that sale contract. That's what gets me going. I'm going to pick up the details and create my exchange agreement with my clients, and then I'm assigned into that contract. So that's how I step into that sale contract. As part of the regulations, I must notify everybody that I was assigned in. It's a simple notice, so it's not rocket science. And then I'm sending settlement instructions to the settlement company. I send settlement instructions to Cardinal Title all day long. Now they know what to do, that this is an exchange, and to send me the cash. So we close, money comes to escrow, and the clock starts. I deal with the 45-day identification step with the clients. Your job is go get another contract to buy something new. I need to get my hands on that contract. I'm checking the list. Is this property on my list? If it is, we're good to go. I need to get assigned in. So I'm going to create that assignment piece of paper, single document. I must notify everybody of the assignment, everybody that's on the contract, and I send my settlement instructions to the closing company on the buy side, sending money back to Cardinal. Hey, we're closing this property. Here's the cash. Client's bringing the rest of the cash. Please deed this thing to my client when it's all said and done. Okay? The client reports everything on this form 8824. The exchange form is 8824. It goes on the client's tax return. Nothing I do goes to the government. I'm just a transaction. Okay? So it looks like a normal sale and purchase, but I add my layer to it. Right? But you're not going to do anything outside the norm of what you're doing today. I use DocuSign like everybody else does, so it all happens very quickly on my part. Titling. So this is about taxes. The taxpayer that sells has got to be the same taxpayer that buys. So Bill Horan sells on my social. I own the property. It's on my personal tax return. Bill Horan needs to buy the replacement property, so I continue to own the same new property on my tax return. Bill and Kathy, my wife, we both made money. Both of us have to replace our investment. Pretty logical. A couple of exceptions. Bill Horan sells, but Bill Horan LLC, with Bill as the sole member, buys the replacement property. That's perfectly fine. It's my business, my sole business. It uses my tax ID number. So it's still consistent. A revocable trust. Bill Horan sells, and then Bill Horan, trustee of Bill's revocable trust. That's perfectly fine. Revocable trusts are disregarded for tax purposes. They don't file tax returns, so we ignore them. And then the Delaware Statutory Trust. I'm going to talk about those in a little bit, but that's another form of ownership that works with an exchange. The purchase of a single member LLC as replacement property also works. Let me use an example. Somebody sells, I'm going to use me, Bill sells, and then I found an office condo that is owned by an LLC with 3 doctors in it. So there's 3 members of this LLC that owns this office condo. I can buy the 3 doctors out, become the sole member of the LLC. So my tax ID number sold, my tax ID number now owns the company that is on deed to that property. That's okay in the exchange. So I end up owning, my tax ID number ends up owning the property, the LLC that owns the property, and that's okay in exchange. Why would somebody do that? So we don't see it around here very much. There's other states where transfer taxes are very high, so people are trying to buy the company rather than the property itself, where you got to go to the courthouse and record a new deed. So they're trying to avoid that. But we don't see it around here very much. DC's got law in their books that if you transfer an LLC that owns real estate, you owe transfer taxes anyway, and Maryland's got a $1 million cap on that. So it depends on the state level whether it works or not. The states know what's happening. They're not dummies. Let's talk about doing it backwards. I got to watch my time here. Let's talk about doing this backwards. So we've talked about selling, replacing that property, changing it. Let me emphasize one other thing. This is not a one-for-one. I could sell 1 and buy 2 or 3. It's about value. How much real estate did I give up? How much real estate did I buy to replace that? And I've got plenty of clients that'll do that. 2 or 3 sales, bundle up all that cash, turn around and buy 2 or 3 replacement properties in different locations. Buy one at the beach, buy one in the mountains, buy one in a new city that's coming up and rip-roaring. Wherever it is, better investment. So it's value for value is really what the exchange is about, okay? All right, let's talk about doing it backwards here. What is a reverse exchange? Well, we talked about a normal exchange, sell and buy. Pretty straightforward sequencing, but that is the sequence by law. There's a couple of rules. You cannot exchange into something you already own. So if you go buy the new one, you can't sell something and buy from yourself. That doesn't work. Improvements on real estate you already own are not like kind. So you can't sell something, have a big bucket of cash that's sitting in escrow, buy something new, have us hold back some cash and then buy a new roof to put on your own property. We're buying shingles. We're not buying real estate. And you already own it. So you can't take money from the sale of your real estate and put it into your own property as part of an exchange. Okay? It doesn't work. These are not the simplest thing in the world. Reverses are a little more complicated. Right? You'll see what I'm doing here in just a second here. Where does this come from? So the government told us how to do this. This is a Revenue Procedure 2000-37. And so we introduced what's called an EAT, Exchange Accommodation Title Holder. It's a straw man, third party. And I'm going to give you a couple scenarios so you see what we're doing. This is where it comes from. Like I said, we didn't create this. This is a government thing. Let me use an example. I found the replacement property, the one I want. That's the deal of the century. If I don't close on it, I'm going to lose it. I got competition to buy that thing. I haven't sold my relinquished property yet. So what am I going to do? We engage an EAT, have the EAT step in and buy the property for us. Exchange Accommodation Title Holder. Its job is to sit there and hold the title, waiting for me to sell my relinquished property. I sell my relinquished and buy from this holding company that's holding the title. So it's a straw man, third party, a way to grab and control that replacement property so it doesn't go away on me. We've been doing more and more of these because of the market, right? You jump in and get the one you want, and then you work on selling because you sell just about anything. Used to be at least nowadays, right? And you control the sales side with your price. But this is we've been doing more and more of this because of the market has been rip-roaring, and clients don't want to lose that good replacement property, right? Where are the issues here? These are not the simplest things in the world to do. Where's the money coming from ahead of time? I have clients that have got cash, so they'll loan the cash to the holding company, the EAT. We step in with an LLC to buy the property. And so the EAT owes money to the client because they are our banker, and it'll sit there and hold title. The relinquished property sells, buys from us the EAT, and we pay back the client because they were our banker. So that's the exchange. They sold and bought, but the client fronted all the money to make it happen. Okay? Where's the other issue in here? How many settlements do we have? Well, the EAT stepped in to buy, that's one closing. The relinquished property sells, just like normal, that's two, and then you got to buy from the EAT. When we do these, we create LLCs, holding companies, that step in and buy title to buy the property. What we sell to the client is the LLC. So if you remember the slide, a couple slides ago, I gave the example of buying the LLC that owns the real estate is okay in an exchange. So functionally, that's what we do. We sell the LLC to the client that's already on deed to the property, and that is the transfer of the property. So it's a pretty straightforward process on our part. We got to worry about what states we're in because of transfer tax issues, where money's coming from. So these are a little more complicated and detailed. The holding company can only hold 180 days. So it's got the same 180 days and 45 days to identify, but these clocks start at different times. The exchange clock is sell, replace in 180 days, ID in the first 45. The holding company clock starts when it holds property, which is a different time. And then the client's got 45 days to tell me what they're selling. Overwhelming majority know what they're selling. And they got 180 days to buy from the holding company. Okay? So they each have clocks, but they're doing different things. I can structure these things to go in either direction. I can buy the new one and hold, which is typically what we do, or I can force the sale of a relinquished property. Because remember, the law says sell and buy. It's got to be in that sequence. So I can force the sale of the relinquished property if I need to. This is all driven about where the money's coming from and what states we're in, and can I avoid transfer taxes. So that's what we talk to clients about when we strategize on these things. But I can go in either direction. Let me use an example of an improvement exchange. I'm selling at $460, right? It's a rental townhouse. And then I found a beautiful beach house for $400. It is the deal of the century. If I go from $460 to $400, I didn't replace what I had, so I'm going to have to pay taxes on that $60 because I didn't fully reinvest everything into that new property. But I need a pool on my new beach house. So I don't want to go down in value, pay taxes on it, and still have to add a pool. Don't want to do that. So what we do is we engage an EAT, let the EAT step in and buy the new property for us, add the pool. So while the EAT is holding the property, it can improve the property. So then the exchange is $460 to $460. I'm using the example of a pool because we can get that done in 180 days. If you're trying to do an exchange and build a house from ground zero, odds are really bad. So from an exchange standpoint, you got to remember, very basic, sell up, give up at $460, you got to replace $460 to not pay tax. So if you're targeting something else that needs a lot of work on it, you can do an improvement exchange, okay? Cool. And we do several of these. This is common because clients want to improve their property. I did an exchange, I'll use an example. I did an exchange for a dentist out of Reston. The developer came in and bought the whole condo complex out of Reston. He took that money from that sale and bought a rental condo in Chantilly. And then we used the rest of the money to buy his new dental office and did the build out. So we used all the money from his sale to do the build out on his replacement property. And so he was a happy camper. He used all his money from his sale into 2 new replacement properties. He didn't have to pay tax to get from A to B. That is a classic example of what exchanging is about and what an improvement is for. Okay? Let me talk a minute about tenancy in common and Delaware statutory trusts. All the old people own all the real estate. They're the ones that have made all the money. But they're tired. They don't want to be the landlord. I don't want to sell a rental and just go get another rental and have to deal with all the issues. Don't want that. So what are my choices? There is a gigantic market space out there, billions, where you can buy into commercial grade properties and be a co-owner with other properties. There's 2 structures, tenants in common, right, where there's multiple names down at the courthouse. And what we primarily see nowadays is what's called Delaware statutory trust. You're buying into a beneficial interest in a trust that owns the real estate, and that is okay in exchange. And it only works because the government said it works. So this is replacement property. So we have plenty, I'll give you a good example. We have clients that want to downsize. You know, they own a $1 million warehouse, but they don't want to buy another $1 million rental beach house or something. That's a huge headache. They want to downsize. So they'll go buy a $500,000 property down in Florida and rent it out and use the other $500,000 and buy into a DST. So remember, it's not a one-for-one, it's value for value. So this gives more options to clients to buy different kinds of real estate. The key on these is you don't do anything. In fact, you can't. The trustee that runs the Delaware Statutory Trust is in charge. All kinds of properties are sold this way. Apartment buildings. We don't see a lot of hotels at the moment, but they're coming back. Same with shopping center. Nobody wants to be Amazon. But the standalones, the triple nets, the ones that stand alone by themselves where the tenant takes care of everything are very popular. I think they're breeding Dollar General stores because they're on every corner. Lowe's, anything in the home improvement, anything in the medical space is all on fire, right? I'll give you a good example. The BJ's out in Gainesville is owned by a Delaware statutory trust. So individuals like you and I own little pieces of that property. Maybe it's a 0.5%, but they put their money into there. BJ's paying rent, and you sit at home and you collect your rent check. There's pros and cons to these things, right? These are not liquid investments, so you're in for a while until the building sells. And depending on the returns you're looking for, right? And you're out of control. So with your own property, you can make your own decisions. But you go into one of these DSTs, the trustee's in charge, so you're out of control. So they come with pros and cons. But we're seeing a good bit of these happening, okay? I'm at 11:03. We're okay? All right. Let me give you an idea, a strategy, right? We call this the last great tax break. You're combining Section 121, homeownership rules, with 1031. Let me use an example, right? I think we all know the basic rules. 2 out of 5 years, you can exclude $250,000 or single $500,000. So let me give you a scenario. I sell a rental property, and I buy a beautiful beach house as my replacement property. It's got everything I ever wanted in it. Elevators, escalators, crow's nests, USB ports, stainless steel, whatever, all the good stuff. I grit my teeth and I put tenants in it for 2 years. I rent it out for 2 years. I've been here in the DC area 100 years. I sell my home and I put $500,000 in my pocket on the home sale. And I move into my beach house. I convert it from a rental to my primary. There's no tax due. I've just changed the use of my property I already own. And I still have $500,000 of tax-free money in my pocket from my home sale. The point is, you don't need to use your home sale money to go buy someplace to live. You already own it. You just change your existing property, okay? So my plan will be to die there. In our business, you swap till you drop. My plan will be pass away. My son will inherit the property. Let's say it's a $1 million beach house when I pass away. His basis steps up to $1 million. He sells it the next day for $1 million. He has no taxes to pay. The estate tax today is about 10 million per person. It's 10.6 or something like that. It's a big number. And so odds are my estate doesn't owe any taxes. So the only way to get out of paying taxes is die. Kind of brutal, but that's the only way to get out of paying taxes. I always get the question, when can I move in? Right? I bought this beach house and I want to move in. So the government knows people want to convert property from personal use into investment status. I usually don't see it on the relinquished side, but the government gave us a revenue procedure on this. If you're converting property, when can you go in, right? When can you change it and be safe for an exchange? On the sale side, let's say I have a second home in the Outer Banks, purely a second home, and I want to do an exchange on it. I'd have to put it into rental status for 2 years before sale. Now I'm holding an investment property on my books, and then I can exchange it. I usually get involved in clients when they want to buy the new one. They're selling a typical rental townhouse, and then they want to buy the new property, and then they want to move in. So what the revenue procedure says is you must rent for 14 days or more for each of the next 2 years. So it doesn't have to be a full-time rental. Couple of weeks of rental per year for 2 years in a row. But you also need to keep your personal use down to 14 days per year for 2 years in a row. When we saw this come out, we queried the IRS on that. 14 days, that's kind of nutso. They said you don't have to be a smart investor, you just have to be an investor. And it's personal use that taints a property. You got to remember, if I own farmland, it's just dirt. I'm just sitting there. I'm not personally using it. I don't live on it. It's just my working farm. So the rental income is not a big deal, but the safe harbor specifies the rental income, right? I think what the government was trying to do was force you to rent a little bit, which causes a Schedule E. And on the Schedule E, that's your rental form. On the Schedule E is personal use. So potentially they pick up your personal use, right? So I think that's what they were trying to accomplish. So now I've moved in, all is hunky-dory, but my plan is changing. I got to move out to the old folks' home. So I have to sell my beach house. I trade it in. Now I live there. Now it's a primary. I've got to sell it, and I'm going to claim my primary residence exclusion. What are the rules around that? So, A, it's a quirk in the law. Yeah, when you buy something as part of an exchange and then you convert it to a primary, you physically have to own it 5 years before it qualifies for an exchange. I mean, before it qualifies as a home sale. Normally on a home sale, it's every 2 years, but because this property came from an exchange, you physically got to own it 5. Now, let's paint the picture. I rent it for 2, I live there for 3, and I got to go to the old folks' home and sell my beach house. They changed the law back in 2009. I don't think anybody's keeping track of this, but they changed the law a long time ago. We now have what's called a period of non-qualified use. So basically, they went after the old strategy of jump into a house, live there for a couple of years, and walk away with $500,000 when you sell it. That's what they were after. So their premise is, wait a minute, you've already owned this thing. You've already got gain in it. Just because you go live in it for a couple of years, we're not giving you $500,000 of tax-free money. So now you have to apply a ratio to the property. Depends on how much time it was a rental versus ownership time. I think I have an example here. Oh, no, I don't. So used to be you sold a home, you didn't even have to fill out anything. There was nothing to fill out. Now, yeah, there's like a 3-page worksheet you got to go through in the back of one of the publications to try and figure out what your tax bill is on the property. My point is the old strategy of jump into a house, live there for a couple of years and bail out has been watered down. The longer you live there before you sell, the better. But you have to apply a ratio of time that it was not your home versus how long you've owned it. And then you're going to get a haircut on the way out. Like I said, the longer you live there before you sell, the more you keep, right? Because that's what they're trying to reward is home ownership, living there, right, as a primary. So I've covered a ton in a very short period of time. There's a lot of material there. Just to make sure we're all on the same page, to do an exchange and follow the safe harbor, you have to use a qualified intermediary, somebody like me, right? I've got to be hired before closing. I hate that phone call Monday morning. Hey, I want to do an exchange. Okay, what's going on? I closed last Friday. I can't help you exchange something you don't own. Oh, it's just paperwork. Fix it. I can't go backwards. Backdating documents for taxes is a bad thing, right? So we don't do that. So I hate that phone call. It's critical that you got to have a QI on board before, because remember, by definition, I'm the one doing the transfer. So if the client does the transfer, that's just purely a sale, pay your taxes, okay? I get started with a copy of the contract. That's what kicks me off. And then I'm going to jump in from there and take over. So hopefully I've covered a good bit for you guys. There's my contact information if you want to shoot me an email or have questions or anything like that. I've got good material that I send out to clients. We have a nice PDF that outlines all this stuff. And then this is all we do. There's a bunch of us there, and our office is in Gainesville, so a bunch of us sitting there doing exchanges. We do them all over the country because this is federal. So you'd be surprised where people are moving stuff from all over the country. It's fascinating. But this is all we do. And so hopefully you've learned something. And thank you for coming this morning. I appreciate it very much.